All right, great. So I'm Greg Smith. I'm with a company called IPX 1031. We're the country's largest qualified intermediary, which means that we just spend all of our time assisting people with Section 1031 exchanges. And, you may or may not be familiar with those. So we'll take it a little bit from the top and go over basics for sure in the next hour, as well as some advanced topics, mix it up a little bit. 1031 in its most basic concept is this idea that when you go and sell your real estate, the government is nice enough to say if you don't pocket anything, but instead you reinvest into more real estate, that they won't tax you on the sale. And you can defer all of the state and federal taxes when you reinvest. So we'll go over the details of exactly what that means today. And see if this next screen wants to pop up for me. There we go. Yeah, if you want to write down that link or go to that link at some point, I'll send you a book of information and my contact information, so you've got that. We should be able to deal with that pretty easily. But 1031 is not something that's new. It's been in the tax code for almost 100 years now. In fact, in January, we're going to hit the 100-year anniversary because it came into the tax code in 1921. So this is something that's been around a long time and is well established, and is something you definitely want to know about and use when it's appropriate. Top left corner there, that's the no gain or loss, is the what's actually in the tax code. And I won't read it you much today, but that's worth going over. So no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, as long as you trade it for the same thing. More real property held for productive use in a trade or business or for investment. So the tax code itself is very basic. Where we get all the extra information about 1031 comes from the Treasury regulations and case law and lots of other places and information from the I.R.S. Bottom left-hand corner, it mentions there that you do want to put in your contracts 1031 exchange language. So it's not required by the I.R.S., but it helps you in different ways. And it is good to mention when you go to sell and also when you go to buy the replacement property that you're exchanging and that the other side agrees to cooperate. What happens on the technical level is that we, as the qualified intermediary company, we become the technical seller when you sell your property. Luckily, we don't have to go into the chain of title most of the time. So you will still deed the property directly to your buyer. When you go to buy your replacement property, that seller deeds the property directly to you. We don't have to get in the middle of that. But the I.R.S. still makes us become the technical seller when you sell. So we get assigned into your rights in the contract. The money from the title company gets wired to us into our exchange account that we technically own. Of course, we're writing the agreement that we own it on your behalf, but then we use those funds on your behalf to buy the replacement property, and we get assigned into that replacement property contract as well. So that's a little bit of the basic way this works. Now, even though the Tax Cuts and Jobs Act is over 2 years ago now, we're still getting used to it, and it still affects real estate quite a bit in ways people don't necessarily realize. So, of course, you've got the slightly lower tax brackets. You've got the corporate tax that went from 35 to 21%. The last two things are especially important to note. The first is that the estate tax doubling up to $11 million per person is huge in real estate. We use the phrase in our industry, swap till you drop. Okay, that means always do an exchange, never pay your taxes, and then once it gets into your estate, for almost everybody, unless you're the 1% and you have bad tax planning, your taxes should go away. So not only does your estate owe no taxes on your real estate that gets in there, but when you leave that property to your favorite daughter, she can turn around and you've given her real estate worth $2 million. She can turn around and sell that the next day for $2 million. And that's completely tax-free money to your heirs as well. So it's really a beautiful thing, really a great thing about real estate. and the fact that they doubled the estate tax limits is huge. The bottom left-hand corner where it says personal property exchange is eliminated. That was huge in the industry. A couple of years ago at this point, we were handling exchanges on just about everything under the sun. We were doing exchanges on business equipment, fleets of trucks, fleets of cars, all the rental car companies like Hertz and Avis and so on. They were using our company, and it'd be one big computer program to keep track of every car bought and sold, keeping track of the vehicle identification numbers and so forth. Because even though, of course, cars go down in value quickly when you drive them off the lot, so to speak, they're being depreciated on the books for tax purposes even faster than they're going down in value. So we were doing exchanges on some fun things like racehorses, artwork, and basically everything other than stocks, bonds, and notes could be an exchange prior to the Tax Cuts and Jobs Act. Now moving forward, it's very simple. It's real estate only. Only real estate can be part of a 1031 exchange, and that's it. So it's made the like-kind concept much easier to deal with, and we'll talk about that a little more. But that's where we're at. No more personal property. If your client is selling a hotel, we used to do an exchange on the real estate and a separate exchange on the personal property, being the kitchen equipment and the furniture and so forth. So those days are done. We can't do that any longer. Oh, too far. Let's run through the taxes here. So people always think the taxes are less than what they're going to be. It's always a brutal thing when they actually have their accountant crunch the numbers and they find out what the tax hit will be. So people think it's a 15% long-term capital gains rate, and it can start out there. On larger deals where you hit this higher income threshold or the gains from the sale itself get you up to that, it's going to jump to 20%. Then the Affordable Care Act added a 3.8% tax when you hit a lower income threshold or gain threshold, even from the real estate. So you can hit these two ways. You can hit these when the real estate has a lot of gain, or you can hit them if the real estate even only has a small amount of gain, but you yourself as the owner have a high income level. So many deals are at 23.8% rather than 15%. And then people forget about depreciation. So, of course, that's the idea that the buildings we have are crumbling away over time. So for commercial property, they use a 39-year schedule for its useful life. And on residential property, it's a 27.5-year schedule. So if you bought a $5 million property where the buildings were worth $4 million and the land was worth $1 million, you would take that $4 million and divide it by 39 if it's commercial, divide it by 27.5 if it's residential, and that's your tax break you're getting every year. And that's a beautiful.
Greg, can I interrupt you?
Yeah, please, Pri.
When you say residential, you mean 4 units and less, or is it everything that's residential?
Yeah, so, I always get mixed up on that myself because there's so many different definitions in different places. So for depreciation purposes, I'm actually not sure which way they're counting. I guess when you are doing your tax return in the end, you probably know if they're seeing that as commercial or residential at that point. But I would say check with your CPA if you're not sure about it. All I've ever read is just the basic residential. So if you had a 100-unit apartment complex, I think that's still considered residential on the 27.5-year useful life. But I could be wrong about that, so I can't swear to it. But I think it's a matter of if it's used for people living there or not. Because yeah, so often we see that 4 units and less as the residential guideline, and I'm not sure if that applies here. So yeah, good question, Pri. Yeah, so I mean, it's a great tax break. It helps real estate investors, so you can offset income each year. But then what happens is you go to sell the property, it hasn't crumbled away, it's gone up in value. So Uncle Sam's going to come back to you and he's going to stick his hand out and he's going to say, hey, we shouldn't have been giving you those tax breaks. You didn't need them. Your property went up in value. Pay us back. And they're going to charge you a 25% tax on that total of the depreciation credits through the years. So this is a real shocker to a lot of people because they might even be in a situation where they think their investment was a dud. Maybe they paid $800,000 for it many years back, and now they're selling the property around that $800,000 price. They're thinking they did terrible on it, but they're forgetting maybe they took $500,000 of depreciation credits through the years, and they're going to get hit with a 25% tax on $500,000. So it can be a real shocker when people don't keep in mind the depreciation taxes. And finally, they forget about state tax. They're so hung up on the federal level. State tax in Ohio, where pre and IR is not the end of the world at 5%, but it still can be a chunk of change. If you're out there on the left coast dealing with a sale in California, 13.3% is a whole lot more brutal. And states vary widely between several at 0%, like Florida and Texas and Nevada, to states that are up in that California range, mostly on the coast. So once you add everything together, the average deal I see come across my desk is looking at taxes that are 30% or more, not taxes at 15%. We see taxes that can be sometimes over 50% when all is said and done. Especially if they've owned it less than a year when they're selling it and they've done well. They could be at ordinary income tax levels. Add in a big state like California's 13.3%. And they are in desperate need of the 1031 exchange at that point. So taxes are brutal. You want to keep that in mind. Now, what is Likekind Property? As I mentioned, this became much more simple after the Tax Cuts and Jobs Act ended exchanging on personal property. So all you need to know about Likekind is it's any type of business or investment real estate can be exchanged for any type of business or investment real estate. So now you can't exchange your principal residence if that's how you're using it at the time of the sale, because that's not business or investment property. You can use Section 121 for that and typically not have to pay any taxes as long as you live there for at least 2 of the past 5 years and a few other items. If it's a pure vacation home, it's not considered business or investment. So if you want to exchange it, you have to change your use, stop using it personally, start renting it out. Then when you sell it, you can take advantage of 1031. Otherwise, you're in no man's land. You can't sell it as a principal residence and get the Section 121 deduction, and you can't sell it as investment property and use 1031 if it's being used as a vacation home when you sell it. But otherwise, everything works. So it's perfectly okay to say, you know, I want to sell my apartment complex and go buy a triple net commercial property. Or you could say, I want to sell my non-income producing land and go buy some apartments that are income producing. You can sell a shopping center and buy farmland, okay? Anything for anything works. Spend a couple of minutes talking about the Delaware Statutory Trust. This may be something that you don't know anything about. It's becoming more and more popular over time. So, when Pre first sees this, he doesn't love the first idea of it, because the idea is you have to have a securities license to sell it. So you've got financial planners that are the sellers of these DST investments rather than real estate brokers and agents. So it's understandable that's not always going to be your first choice in what you're looking at. And it certainly doesn't always work in every situation as a possible investment anyway. But there are situations where it works. So I'll briefly describe what it is. So a few decades ago, some investors had a pretty smart idea. They said, hey, what if we go out and buy blue chip properties that might be worth $50 million or $100 million, things most investors can't afford to buy unless they're the pension funds or the insurance companies or the real estate investment trusts out there who have that kind of money to spend on real estate. So what if we bought those and then chopped it up into pieces to sell off to investors? So maybe these investors are coming in with $500,000 or $2 million or a couple $100,000, wouldn't they like to buy a blue chip property where they know their rent checks coming in each month, and then they can sit back and collect that without having to worry about any management responsibilities and so on? And that idea appealed to a lot of people, and they started rolling these investments out. They were popular, except that a lot of the CPAs and attorneys out there said, you know what, we don't think this works for 1031 exchange money, which is a huge proportion of the money out there in both the commercial and residential markets. We think that when you sell over here as Joe and Cindy, that you need to buy as Joe and Cindy. These deals you were buying as something that felt like a partnership, and the IRS might not respect it. Well, in 2002, the IRS came out and blessed what was then called the securitized TIC industry, TIC standing for tenants in common. And then what happened is that industry had billions of dollars flowing into it right up until the time the Great Recession hit. When that hit, everything in real estate slowed down, and there was a trend that moved over away from the securitized TIC setup as the way to own the real estate over to the Delaware Statutory Trust. And that's where most of these properties are held today in the DST format. And that's just a wrapper for how to own the real estate. So under the securitized TIC, you could only have up to 35 owners. Now you can have up to a couple thousand owners in the DST. That lets people come in with smaller amounts of money. And under the old TIC format, you had to have unanimous approval of all the major decisions, which is impossible to do with a big group of people. So under the DST, you've got a trustee running the investment. So a company like Inland out of Chicago, and I mention them because they're the biggest player in the DST market. They have more than a 50% share of the DSTs that sell nationwide. And they'll go out, they might buy some giant multifamily complexes, apartment complexes, or they might buy a group of CVS or Walgreens across the country, maybe buy 12 of those in different cities and states. And then they'll package those into an investment and sell those off. And you're coming in with your $200,000 from your rental property sales. You can easily invest into one of these within the 45 and 180-day exchange periods that we'll talk about. So when you're, someone like some of you have real estate licenses possibly on the call. So this wouldn't be the first thing you'd maybe go out there and find for an investor, but there are times where it helps you. And it can be a first choice. Your client's the farmer who's selling the farm, doesn't want to go out and manage real estate on the replacement side. That can work as a first choice. It can be a backup in the identification process that we'll talk about. So you're pretty sure you're going to buy the property down the street, but you name a couple of DSTs in case that first one falls apart, you decide not to buy it. Now you've got some backup choices. And then the third, and maybe the most likely, is for what we call the scraps. So this could be that you sold property over here for $800,000. You found the perfect property you wanted on the replacement side for $600,000. Well, that $200,000 gap that you've gone down in value could end up being taxable boot in the end. So if you go out and reinvest that $200,000 into a DST, you can stay 100% tax deferred and everybody's happy. And I didn't mention at the beginning, I should have, that I'm going to be speaking for roughly an hour, maybe a little bit less for you today. And then we'll have plenty of time to take questions as long as you want. So jot down any questions. Feel free to interrupt me as we're going. I don't mind that as well either. But we'll have plenty of time to take questions at the end, whatever's easier for you. So that's the basic idea between the Delaware Statutory Trust, the DST investment, just something that you want to know about. We are seeing more and more investments into DSTs. So here's the basic idea once you're in a 1031 exchange. The IRS wants to pretend that even though you might own property B instead of property A, that nothing's changed. And if nothing's changed, they won't tax you on the sale. So specifically what that means is, under number 2, they want you to reinvest all of the net proceeds. So after you've paid your real estate commissions and title fees and the normal things you see on a closing statement, after you paid off any mortgage debt, whatever cash would normally be handed to you at the closing, whether that's in a check or a wire, instead that money gets sent to the qualified intermediary and you use all of that as down payment on the new property. Then number 3 is the other part of it. If you paid out $212,000 to the bank at closing as your payoff, they want to see you go get a new loan on the new property of $212,000 or more. And as it tells, you can also, does it have that on the screen? I didn't even mention it there, but you can also replace the debt with additional cash. So, you know, if you paid off $212,000 the bank, replacement side, you didn't want to get a loan, or maybe you're buying a nuclear waste dump and the banks won't give you a loan on the new property. You could bring $212,000 of your own cash from outside of the exchange, buy the new property with all cash, and that would still defer all your taxes. Number 4, don't receive something that's considered not like-kind property. That doesn't really come up too often. If you were selling farmland for $1 million and you bought a hotel for $1 million, you might initially think that matches up perfectly, but maybe you'd realize that, uh-oh, that's a couple $100,000 on the hotel side of kitchen equipment, furniture, and so on that won't be considered real estate value. So you didn't really match up 1 million for 1 million in the end. But in the end, the 2 things you want to realize are spend all the cash from the sale and replace the debt. The other way to look at that is your magic number to get 100% tax deferral is your sale price minus the closing costs. Okay, so either that number or adding the debt to the proceeds, those should be the same figure in the end. I'm going to quickly go through this part, but if someone's a true flipper, so they buy homes, they fix them up, and they sell them 3 months later, they want to do that again and again and again. The IRS calls that the inventory of their business, not an investment. So they don't want to give them investor treatment. They don't want to allow them to use 1031. So if your intent when you buy a property is to hold the property primarily for resale, as opposed to holding it primarily for use in a trade or business or for investment, they'll say you're not 1031 eligible. So if you're a developer and you go out and you build a shopping mall and immediately sell it, not 1031 eligible. But if you build that shopping mall and you manage it for 5 years, then you go sell it, now you are 1031 eligible. If you fix up a house but rent it out for, say, a year, now you're okay. But if you fix it up and sell it immediately, you might not be. Okay. I mentioned residences and second homes. I'm going to skip that for now. Here's those timelines I've been mentioning. So from the date you sell your real estate, you've got exactly 45 days in most cases to identify what you're going to buy and 180 days to get closed on your new property. Now, there are very few exceptions to this rule. Sometimes military deployment can be an exception that would get you some extra time. And the other one that we come across, federally declared disasters. So we happen to be, of course, in the middle of one of those right now with the coronavirus. The IRS did something strange this time. Unlike every disaster we've seen through history that they handled a certain way, they handled this one differently. Quite honestly, they kind of messed it up. They decided to lump 1031 along with opportunity zones and a number of other things in their guidance. And the guidance came out a few weeks back and it said, if you've got a deadline in your exchange between April 1st and July 15th, July 14th, I should say, you automatically get extended to July 15th. So let's say your 45th day deadline happened to be April 2nd. You got a pretty big benefit. You got all the way until July 15th to do your identification. So that's great. But for most people in the mix of that, you're not getting a whole lot out of it. What they've always done in the past is they've said you automatically get an extra 120 days on both of your deadline dates. That would be much more helpful. So we've gone back to the IRS, and our general counsel for our company, Suzanne Goldstein Baker, has led the charge of a big group of much more powerful lobbying groups than our little Federation of Exchange Accommodators. So that includes the National Association of Realtors and a bunch of other groups. And Suzanne has led that charge. The IRS did get in touch with her about a week and a half ago, and they were asking questions about it. They didn't realize they had done things differently in the past because of who was involved in those decisions. And we are hopeful that they're going to give additional extensions. There's no guarantees at this point, but we do think they're going to do that. So usually you got your 45 and 180. In this case, we might get a little more. This screen is just what I just said. So right now it's if you have a deadline between April 1st and July 14th, you're extended out to July 15th. We hope they're going to add to that extensively. Now there's this thing we call the mini deferral, which is I think something interesting for you to know about. Most of the time I don't have to really be a great salesperson in my job. You know, it's a shame for me to admit that. But the truth is this product sort of sells itself, right? All you need to do is teach about it a little bit and people say, oh, wait, I can pay $180,000 in taxes, or I can keep all my money and reinvest it. Yeah, I'd rather reinvest 100% of my money, thanks. So the product sells itself once people know what it is. Every once in a while, somebody comes to me and they're on the fence and they say, I don't know if I can find what I want as the replacement property, or maybe my tax hit is pretty minor. Maybe I'll just go ahead and pay it and stick my money in the stock market. So once in a while, I have to put on my salesperson hat and, you know, try to convince them a little bit. And I say, well, you know what? Look, you're selling this property on December 1st. And since you're a regular taxpayer where your tax year ends on December 31st, you have extra incentive to try the exchange. Okay, because what that means is if you don't find what you want to buy in that 45-day period and you decide to let your exchange end, you'd be getting your money back in the middle of January of the following tax year. So what you can do then is report that as an installment sale where the QI did not return your money until the next tax year, and you're going to put your tax bill off for another year. So that's pretty sweet. Now you can also use this concept with the 180 days. And we've got some large corporate clients who abuse this a little bit, I think, and they're not supposed to do that, but you're supposed to have a bona fide intent to exchange. But let's say you sell your property on September 1st, and your tax year, in this example, we're going to say ends at December 31st. Within 45 days, you would identify properties that you might plan to buy. But let's say you either didn't buy those or you didn't buy all of those, so there was some money left over. And in the end, that money, once again, is going to come back to you in the next tax year. You can report that part as an installment sale and put off the tax bill a whole nother year by doing so. So that's what we call the mini deferral. It's also called tax year straddling, and can be a nice bonus of a failed exchange if you get in that position. All right, here are the identification rules. These are a little strange. They could have made this much simpler, but they came out with something called the 3 property rule. They thought they were being very kind because you didn't have to just sell one property and only identify one to buy. They're going to let you identify 3, have a couple backups in case something goes wrong. Or of course, in some cases, you may want to buy 2 or buy 3. But then people came back and they said, hey, that doesn't always work, IRS. Okay, there's times where I'm selling my property over here for $1 million and I want to go buy a bunch of properties for $100,000. I want to diversify. I might want to buy properties in many different states. Or it may be that I'm selling this property and I have 3 kids and one lives in Florida and one lives in Texas and one lives in California. I want to buy one property each of those 3 places, and then eventually I'm going to let the kids run those properties and I'm going to pass those on to them in my estate. And I gave a bad example there. I need a 4th kid, but you get the idea. People want to buy a bunch of properties. So 3 property rule doesn't work. They came up with a 200% rule. What that says is if you sold for $1 million, 200% would be $2 million. So that's your aggregate limit, which would mean you could name 20 $100,000 properties and still be within that $2 million, but you can't name a 21st or you're over your 200% limit. So a little bit of a strange rule, but that's what they came up with when people wanted to diversify and buy less expensive replacement properties. Then there's the 95% exception. You don't want to rely on this. It says if you break those two rules, so you're identifying more than 3 properties and the value of those properties exceeds 200% of the value of what you sold, now they'll still accept your exchange, but only if you acquire 95% of the value on your list. So in most cases, that would mean if even one property on your list you can't close on, your entire exchange is going to fail and you're going to owe all your taxes. So you want to stay away from the 95% exception. A question I get quite often, usually a few times a week, all throughout the year, is, hey, Greg, I've got this property that I use as a vacation home, but I also rent out. Or on the replacement side, I want to buy a property that I'm going to use as a vacation home and also rent out. And usually it comes from a place of the investor saying, I really want it to be an investment. I usually want it to be a vacation home, but what do I have to do to make it 1031 eligible? So the IRS did give us some guidelines here a few years back. They call it a safe harbor. It means if you meet those guidelines, you know your exchange can't be challenged. But if you're outside of these, you might be okay if you get audited, or you might not. So what it says, let's say you sold an office building and now you want to go buy a beautiful home on Hilton Head Island. So the IRS says, all right, in the first 2 years, make sure you rent out that new home at least 14 days in each of those 2 years, and don't use it personally more than 14 days in each of those 2 years, or 10% of the total number of days rented. So if you were lucky enough to rent it for 300 days, you could use it personally 30 days. And if you can live with that for 2 years, once you're into the 3rd year, you can do anything you want with that property and you'll be okay. Your 1031 can't be challenged. Your taxes won't be due. Okay, so that's called a safe harbor, and that's how you look at the difference when you've got a mixed use, vacation, and investment property. Same taxpayer requirement, or we call these vesting issues, seems very simple. Whoever the taxpayer is that sells needs to be the taxpayer that buys the replacement property. So if you sell as John, you buy as John. If you sell in an LLC or partnership, you need to buy in that same LLC or partnership. Sell in a corporation, buy in a corporation. Seems so simple, but there's lots of things that get messed up. One is simply spouses. You know, it might be that one spouse owns the property that's being sold. When they buy the new one, they want to buy it together. That can be problematic because the IRS is only looking at one taxpayer on the sale side. You need to match up those dollar amounts on the replacement purchase side. It can go the other way as well, where both spouses are on title when the property being sold. Maybe only one wants to go on title on the new one, or maybe one has credit issues, things like that. But you do have to match it up, so that's important to know. It also comes up with what we call disregarded entities for federal tax purposes. So a single member LLC, a revocable trust. Those are the two main disregarded entities. What that means is when you own a single member LLC, where you're the 100% owner of that, you don't have to file a separate tax return for that. All the information flows through just directly onto your individual tax return, and that gives you some benefits in the 1031 world. Maybe it's that you're selling a property in your LLC, and when you go to buy the replacement property, the lender with the best program, maybe it's a residential program, they say, you know what, we only want to give a loan to an individual, not to an LLC. Well, that still works for 1031 purposes because the IRS will see John exactly like John's LLC. Or maybe you sell some land as John, and on the replacement side, you're buying an apartment complex where you think there's more liability. Now you want to buy in an LLC. That will work as long as you're the sole owner of the LLC. All right, skip those other issues and keep moving. By the way, if you send me your info so I can send you the book, everything that we're going over today is going to be in that book of information I'll send you. The types of exchanges. So we've been talking mostly about a delayed exchange. A delayed exchange is where you have that 180-day time period, and that's what 90% of exchanges nationwide end up being, delayed exchanges. A simultaneous exchange is technically when you and someone else exchange properties directly and no money's change hands. So you've got the property they want, they've got the property you want, and you just trade. That's a simultaneous exchange. The simultaneous exchange is the one type of exchange that the IRS does not require you to use a qualified intermediary for.
Come here,
So you can do those without a QI.
Walk around, there's too many here.
And any other type of exchange, you do need to use a QI. The reverse exchange is where you need to buy your new property before you've sold your old property. So the IRS gives you a way to do it. Unfortunately, they don't make it easy. What they say is you're not allowed to own both properties at the same time. And if you're buying your new property first, well, how do you avoid that? A third party called an exchange accommodation title holder has to step into your shoes. What that means, practically speaking, is that we're, as a QI, we're going to set up a new LLC. We will take title to the new property when you're ready to buy it. And then from that date, you have 45 days to identify what you're going to sell. That's usually pretty easy. And you have 180 days to get it sold and complete the exchange. A build-to-suit exchange, also called an improvement exchange or a construction exchange, is where maybe over here you've sold a building for $2 million. On the replacement side, you're going to buy something for $400,000, and it's either bare land or maybe it's existing buildings that need to be fixed up. So you want to include the new construction in your tax numbers. And if you sold for $2 million and bought for $400,000, you've got a long way to go to get to 100% tax deferral. So the good news is, again, the IRS gives you a way to do it. The bad news is they don't make it simple. Again, you're going to use a company like ours. We're going to take title to the replacement property. The bad news is you've only got the rest of your 180-day exchange period to do improvements. Then when we get to day 180, we're going to deed the property over to you. You're going to get credit for whatever the real estate is worth at that time. So let's say in that example where you sold for $2 million and bought land for $400,000, maybe you were building a $5 million building on it and you're only partially done, but that may be more than enough to get you full tax deferral. So there's no requirement that it's completed. It's just that you only get credit for how much real estate is completed at that point for your 1031 exchange numbers. Finally, the reverse build to suit puts those last two together. That's where you need to buy your new property first and do construction before you sell your old property. As far as pricing, this is something good to know. We have flat fees. So on most exchanges, the simultaneous or delayed exchanges we handle, we charge $750 to set up an exchange and handle the sales side. We charge $250 to handle the replacement property purchase side. So the vast majority of exchanges nationwide have a total fee of $1,000. With a reverse or a construction exchange, those are very different because we have to go into title. We have a lot of risk involved in that. Believe it or not, we get dragged into a lot of lawsuits because of that stuff, because we own a McDonald's in Phoenix and someone gets run over in the parking lot, or we own an apartment complex and a murder takes place. Everything happens eventually. Then the biggest one that we have to worry about is probably the EPA. If there's ever an environmental problem with that property, we get dragged into the lawsuit because we were in the chain of title. So that's a big reason why those types of exchanges are much more expensive to handle. There's also more paperwork. We're going to deal with lenders in a much more direct way on those deals. So you're looking at fees typically between about $5,000 and $8,000 on reverse and construction exchanges. So you'd want to build that into your thinking if you want to go that route. Then there's this last thing we call the combination exchange. It's not really a different type of exchange, but it's combining two types of exchanges to give you a benefit. So let's say you have 10 rental properties scattered around town, and you decide you'd like to sell all of those and buy one big apartment complex. For simple numbers, we'll say each one you're selling is going to be $100,000 each of those 10 properties. and the apartment complex that you're buying is going to be $1 million. So you want to sell those one at a time to get the best price you've decided, not sell the 10 as a package. So the problem is when you sell that first one, your time period starts to run. You're in your 180-day exchange period. So in a perfect world, you sell the first one, you negotiate with the seller of the apartment complex to put that purchase off near day 180. And you go out and you start selling your properties. Let's say you've sold 6 of those before you have to close on the new apartment complex. That's great. You've got $600,000 of sales. We're going to have you replace into a $600,000 piece of the apartment complex, and you've deferred all your taxes on those first 6. But the bad news is you've still got 4 more you want to sell, and you'd like to defer those into the complex. So what we do at the same time is we start a reverse exchange. We'll take title to 40% of your new apartment complex, own it sort of momentarily in time with you as tenants in common, and then from the date of that closing on the new complex, you now have another 180 days to sell your other 4 properties and complete your exchange, being 100% deferred on all 10 properties. So we call that a combination exchange, where you're putting a delayed and a reverse exchange together, and you have at least one property in common. Something good to know about. All right, I'm going to skip seller financing for now, except to just say that you want to avoid seller financing with exchanges if you can. It can be complicated to jump that hurdle. Okay, talk for a couple minutes about what a qualified intermediary really is. I'm going to try to bring up a video, and sometimes the technology works. So we'll see if it wants to work with us today.
I don't think it's working. Greg, I don't think it's working.
Oh, you're not seeing the video?
No.
Oh, okay. One
Can,
sec.
can anybody see the video? I don't think anybody can see the video.
Okay. Hang on one sec. Close that out. Let me bring the PowerPoint back up. Oh, sorry, I did from beginning. That was dumb. All right. Well, actually, I don't need the slides at this point anyway. All right, Priya, you're seeing my screen again?
Yes, we can.
You couldn't see that video on the screen when it was up?
No, what I saw was the PowerPoint was still on the screen and no video.
Oh, sorry about that. That's strange. Yeah, I took it down. Well, all right. Let's not worry about the technical difficulty. I'll just move on. It worked the last few times I did that. I don't know what happened there. Maybe I don't know. Maybe because I'm not the host of this one, it might have gotten messed up. But
Probably.
so what that video was showing was a guy named Ed Okun, and he became the star of a TV show called American Greed that some of you may have seen through the years. And we had seen what Ed was doing ahead of time, and we thought it was great. Ed was going around the country and he was buying up legitimate qualified intermediary businesses. And a lot of the people running those businesses used to work for IPX and had gone out and set up their own shop. And let's say we thought a business based on the competitiveness and the deals we thought they were getting, maybe it was worth $1 million. Well, Ed was paying $2 or $3 million for those businesses and closing almost overnight. And it wasn't because he couldn't put a value on a business. He had the largest accounting firms and law firms doing these deals for him. So knowing that, we said, this is great. This means Ed is trying to corner the market because he's got politicians in his hip pocket, and capital gain taxes are about to skyrocket. You might remember back when President Obama was running before his first term, he said he was going to jack up capital gains taxes significantly. And he gave specific numbers and said he was going to really raise it up quite a bit on the middle and upper class to help pay for some of the proposals. And it didn't end up happening because, of course, there was a Republican Congress and they didn't want to let taxes go too high. Some things happened, like I mentioned earlier, that 15% rate jumped to 20%. From the Affordable Care Act, they added that 3.8% tax. So there were some shifts upward, but not the kinds of things President Obama was trying to do. He wanted those significantly higher. But we thought it was going to happen when we saw Ed going around the country buying up those businesses. And basically, you know, we were very wrong. Okay, he wasn't doing it to corner the market because capital gain taxes were going up. He was doing it because he wanted to get his hands on other people's money to use for his own purposes. And what you would have seen in that video, had my technology worked, you would have seen the 3 jets that he purchased. You would have seen all the real estate that he bought. You would have seen the yacht that he purchased, on and on and on. He was spending hundreds of millions of dollars of other people's money for his own lifestyle. He did not end up with some kind of white collar slap on the wrist. He's in prison for the rest of his life. He'll never get out. He got concurrent 100-year sentences. He's got no chance of parole. You know, what he did was awful. Sadly, he was not alone in that type of thinking and behavior. We've had a whole lot of bad things go on in our industry through the years. There was a company called Southwest Exchange that stole hundreds of millions of dollars from people. There have been giant bankruptcies that hurt a lot of exchanges, and a lot of other, you know, hundreds of other instances of theft and so forth. So the reason you need to know this is we're a completely unregulated industry at the federal level, and only a few states have state regulation. So anyone can be a qualified intermediary. You would think with capital Q, capital I, coming from the Treasury regulations, calling us this qualified intermediary, right? You would think we have qualifications. Sadly, the only thing you have to do to be a QI is not be disqualified, okay? You're disqualified if you have an agency relationship with your client. So those of you who are real estate agents on the call today, you cannot act as the QI for your customers. If you're an attorney, a CPA, a banker, a financial planner, and so on, they can't either. Okay, no one with an agency relationship can do this for their clients, but anyone else can do it. So it's a pretty scary thing, and you want to know who you're dealing with. So of course, as the commercial for our company, I'll throw out there that we are the largest and safest. We're owned by a Fortune 500 company called Fidelity National Financial. They're in turn the largest title company in the world. They own Chicago Title, Fidelity National Title, Commonwealth, and others. So one good thing about that is they're actually able to guarantee the safety of every exchange. So if your client says, I don't know this Greg Smith guy, what if he runs off with my money? First and foremost, that's exactly the question they should be asking. And then secondly, we've got pretty good answers for that. We've got a $100 million Fidelity bond, $35 million in errors and omissions insurance, but most importantly, a $50 million performance guarantee on every exchange that comes from this family of title companies that says, hey, if anything goes wrong, you know, we've got money set aside in every state for losses. We'd be on the hook to make you whole. So any QI, you need to do your homework on them. Make sure that they can answer the question, if your money disappears, how do you get it back? And make sure you're happy with the answer, because unfortunately it is unregulated and bad things happen far too often. So that's a little bit about the QI industry in terms of the security. What we do is a practical matter. You call me up, you say, hey, Greg, you know, we want to do this exchange. I'm going to walk you through the process, make sure you understand it. I'm going to talk to the title agent handling your closing. I'm going to have them send us a copy of the contract and the title commitment. We review those 2 documents, and then we draft up the exchange paperwork you need. We're going to get that sent out to you, and it needs to be signed anytime at or before that first closing when you sell the property. Then the title company is going to wire us those funds from the sale. And of course, we're going to send you a form for your 45-day identification. If you close in the first 45 days, you don't even have to do the identification form. That makes it simple. But if you're going to close sometime after day 45, you're going to fill out that form and get it back to us. Then when you're ready to close, it's a little bit of the same process. You're going to go ahead and let us know who the title company is. We're going to get the contract, the title commitment, and their wiring instructions. We're going to draft up the little bit of paperwork you need for the back end, get that sent out, and you're going to authorize, the funds to be sent for the purchase. So in a quick nutshell, that's the process for how an exchange works. Okay. We're about 5 of 1. I'm going to go ahead and stop there and take questions about anything that we've gone over, or maybe topics we haven't gotten to today. I think Pri maybe already has you unmuted from his end, so if you just want to unmute yourself and ask any questions or make any comments, I'm happy to talk about anything you'd like to.
Okay, I have a question, Greg.
Yeah, please.
And thank you very much for doing this presentation. It just happens to be a topic that we wanted to learn a lot more about right now. So it was very fortuitous. My question is in the like kind, because I've read 2 different opinions on this, and that's if I sell an investment property and I buy a real estate note, can I buy notes with a 1031 and do the transfer that way?
Yeah, so unfortunately, that was a subject of debate back before the Tax Cuts and Jobs Act went through. And you would talk to some advisors that thought notes could work, or they would say you could exchange a note for a note. It's kind of a moot point at this juncture in time, because now it's strictly real estate for real estate, and a note definitely does not meet the definition of real estate as things currently stand. So it does have to be a direct owned interest in real estate, and unfortunately a note doesn't qualify.
Okay. And does it complicate matters dramatically if the properties are in LLCs or trusts?
Well, not necessarily, but it does go to the vesting issues. So where it could get complicated is if you're selling a property, let's say in a 3-member LLC, and some members want to do an exchange and others don't. There's ways to work it out, but there can be complications there that we'd want to have some time to work through prior to the sale. But as far as, any LLC can do an exchange, any trust, any corporation, any individual. But when you have multiple owners and maybe some want to go one way and some want to go another, that's where we'd want some time to work it out.
Yeah, that's not really an issue. It's just my wife and myself. So
okay, yeah, so no problem. It's just you'll match it up. So if you sell a property owned in a 2-member LLC with a husband and wife, then that same LLC is going to need to be the buyer on the replacement side.
Okay, thank you.
Sure. Thanks for the questions.
Anybody else has? Lisa, do you have any questions?
Okay, well, nobody else has got anything to say.
I'm sorry, I was trying to unmute myself and it wasn't going well. So here I am. I don't currently have any questions. I just want to thank you so much. What an insane wealth of information you just brought us. Some of it a little overwhelming, so I'm definitely going to have to get your materials so I can hash through it all. But wow, your presentation was most impressive. Only other comment other than just thank you is, man, I still wish that you could exchange racehorses. That would be fun.
I'll tell you, Lisa, thanks for your comments. I did one that was a lot of fun years back, and this was probably 15 years ago, and they sold a gelding. And I'll be honest, at the time, I didn't even know what a gelding was. And what's really interesting, right in the tax code under Section 1031, it used to have 2 footnotes. The first footnote said, gold bullion is not like kind to silver bullion. And the second one said, male livestock is not like kind to female livestock. So for whatever reason, they felt it was really important to put those things in the tax code back in 1921 or thereabouts.
That's
And we had to live with them.
hysterical.
Yeah, right? And so when these people were selling a gelding, it became a real issue. What could they buy on the replacement side? And we knew they couldn't buy a mare or any kind of female horse once we did our homework on this. But the question became, could they even buy a stallion, or would that be seen as not like kind? In the end, we got lucky. They wanted to buy another gelding, so it ended up being gelding for gelding, and we were off the hook for any more homework on that one. But yeah, we used to get into those kind of crazy issues all the time, or with artwork. Could you sell an oil-based painting and buy a sculpture? Well, as crazy as it was, sometimes that type of thing worked, but at the same time, you might not be able to sell a pencil sketch and buy, some other type of art, So we got into all kinds of crazy things. But yeah, I wish none of that had gone away too, because the next time real estate is slow, that's going to be a lot less business I can go after.
I was going to say, so you're missing all the fun, but you probably don't have to work quite as hard. And I don't know about that male-female thing. I don't think we could get away with that now, because it's probably a little sexist, don't you think?
Yeah, absolutely. I mean, we used to joke that it was like proof that, men are from Mars and women are from Venus. They even put it in the tax code, but who knows?
Oh my gosh. Well, hey, maybe when things slow down, they'll change it all up for you so you can start dealing with art and animals again.
Sounds good.
Okay, so one last question for you, Greg.
Yeah, please. No hurry. I got plenty of time.
On the safe harbor section, so if I had some rental properties, say here in Columbus, and I wanted to buy some properties in a resort area, Hilton Head or Florida or something, and turn them into Airbnbs, that's a perfectly acceptable way to do that then.
Absolutely, yeah. Airbnbs qualify as investment property, and as long as you under that safe harbor, as long as your Airbnb rental nights would cover 14 days in each of those first 2 years, you're certainly safe with your exchange. And once you get to year 3, you could keep using it as an Airbnb, or you could move into it, or you could make it a vacation home and not rent it out. You'd have total freedom once you're to year 3.
Okay. All right. And was that your email address, like on the first slide? We contact you if we want a copy of your publication.
Yeah, here, let me, I can put it back on that
Yeah, Greg,
slide again. So
can you email me the slides, and then I can email it to everybody so they have the slides as well as your contact information?
Sure. Yeah, I'd be happy to do that.
All right, and thank you, Pri, for arranging this.
Yeah. I appreciate that as well, Pri. I'm glad you're able to bring us together. And I guess unless Pri has something to say, I'll just, or are there any other questions? I'll let Pri have the last word here, but thanks, everyone.
Well,
super thank you. Super thank you. And have an awesome rest of the week and weekend.
Yeah, you too.
thank you, everybody. And I will definitely send out Greg's contact information to everybody so you guys have it and you guys can contact him. And as soon as I get the slides from him, you'll get the copy of the slides, and this is being recorded and it will be on YouTube. I'll send out a link so you can share it with your friends, or if you want to watch this whole thing again, you can go through it. Other than that, thank you. Greg, thank you.
Yep, my pleasure. Have a great day, everyone.
And thank you. Yep, and thank you, Pri. You're the best.
Thank you. Okay.
Bye.
Bye. Okay, Greg. We'll see you sometimes in the.
All right.
meeting.
Sounds good. Take
Okay.
care.
Bye.